everyone. Today our group will be presenting a business case study of Wood-Edge Sendirian Berhad. We will use cost volume profit to evaluate business performance and give recommendation for future decision making. Now I will introduce the company. Wood-Edge Sendirian Berhad is an electrical supply company that sells energy efficient LED lighting kits under the brand name Bright Edge. In 2025, the company sold 75,000 units with total sales of 1,500,000. The business aimed to achieve a net income to sales ratio of 30%. So to help the company to hit the target, we will use CVP analysis. It is to analyze the relationship between cost, sales, volume, and profit, and also to determine the break-even point. In addition, we also can find that whether the company can achieve its target profits and provide recommendation for company for the future decision making. And based on the financial statement that provided by Wood-Edge Sendirian Berhad, this is the information we will get. Sales revenue, units sold, variable cost of goods sold, fixed cost of goods sold, sales commission, fixed operation expenses, and net income. This all information we will use in the CVP analysis. Now we will go to the calculation. First, we calculate the sales price per unit. We will use total sales divided by unit sold, and we will get RM20 per unit. The next one, we calculate total variable cost. We will use variable cost of goods sold plus sales commissions, and at the end, we will get 975,000. Moving on, we calculate variable cost of per unit. We will use total variable cost divided by unit sold, and we will get RM13 per unit. Next, total fixed cost. We will add all of the fixed costs in here that's shown in this formula, and lastly, we will get 315,000. Next, contribution margin per unit. We will use sales price per unit minus variable cost per unit, and we will get RM7 for it. Next, contribution margin ratio. We will use contribution margin per unit divided by sales price per unit, and the ratio will be 0.35. Now we calculate break-even point in units. We will use total fixed cost divided by contribute margin per unit, and now we get 45,000 units. Last one, we find break-even points in amount RM. We will use the break-even points units times sales price per unit, and we will get 900,000. Now, to hit the target, which is a net income to sales ratio of 30%, we need to calculate that the units that has to be sold by Wood-Edge Sendirian Berhad. So the first step, we need to calculate the target net income first, which is use the sales times 30%, and we will know that 30%, which is RM450,000 that need to be earned by the company. Now we calculate the contribution margin, which is use total fixed cost plus the net income, and we will get 765,000. Next, which is the last step, we need to calculate the units needed to be sold, which is use the required contribution margin divided by the contribution margin per unit, and we will get 109,286 units. To hit the targets, we will give some possible actions for the company. The first one is offer discount. This is to encourage the customer to make a larger purchase, and company can move closer to the target. The next one is expand distribution channel and market coverage, which is we not only sell the goods in physical store, but also we can sell the goods on the online, such as Shopee, Lazada, and others online platform. And the last one, understanding buying habits and industry trend, it can also help to generate the revenue growth.
Question number 3 is selling price if unit sales cannot be increased. For the calculation, we get the new selling price at the 24 ringgit and 57 cent. This shows an increase from the 20 ringgit. The new selling price must be at the 24 ringgit and 57 cent to maintain the 30% of operating income with 75,000 units. Increasing the price may lead to a decrease in demand unless the product has high brand loyalty or low competition. Simply increasing the price without add value might drive the customer to the competitors.
Next, we move to question number 4, which discusses the product improvement plan. The company plans to improve product quality, which will increase variable COGS from 50% to 55%. Fixed advertising expenses will also increase by 5,000 ringgit. However, sales volume is expected to increase by 200%, while the selling price remains at 20 ringgit per unit. With a 200% increase in sales, units sold will increase from 75,000 units to 225,000 units. This results in total sales revenue of 4.5 million ringgit. Variable cost consists of variable COGS of 2.475 million ringgit and sales commission of 675,000 ringgit, giving total variable cost of 3.15 million ringgit. The contribution margin is calculated by deducting total variable costs from sales revenue. Therefore, 4.5 million ringgit minus 3.15 million ringgit gives a contribution margin of 1.35 million ringgit. Total fixed costs increased slightly from 315,000 ringgit to 320,000 ringgit due to higher advertising expenses. After deducting fixed costs from the contribution margin, the net operating income is 1.03 million ringgit. In conclusion, even though costs increase, the significant rise in sales volume leads to much higher profit. Therefore, the company should proceed with the product improvement plan as it improves profitability and strengthens competitiveness in the market.
Next, we're going to the question 5, that is, advise the company whether or not to approve the agent's request. In question 5, the company is faced with its sales agent requesting an increase in the sales commission rate to 20% for the upcoming year. Then the company plans to change and will hire 6 sales agents to cover the current market area. And the fixed salary cost of each employee will average 1,250 ringgit Malaysia per month. In addition to their fixed salary, the 6 sales agents will each earn commission at the rate of 5% on all sales. So first of all, we calculate the sales commission and the request increase of 20%. In sales commission, we use the 15% multiplied by 1.5 million and equal to 225,000 ringgit Malaysia. And for the request increase of 20%, we use the 20% multiplied by 1.5 million ringgit Malaysia and equal to 300,000 ringgit Malaysia. Next, we calculate the fixed salary cost and commissions cost for the 6 sales agent. So we use the 6 multiplied by 1,250 and multiply by 12 and equal to 90,000 ringgit Malaysia. For the commission cost, we use the 5% multiplied by 1.5 million and equal to 75,000 ringgit Malaysia. So the total cost is fixed salary cost plus commission cost, and we get the total cost is 165,000 ringgit Malaysia. Based on this result, our advice is reject the agent request for increased 20% commission on sales and approve hiring 6 on sales staff. By hiring 6 on sales staff will save 135,000 ringgit measure compared to 20% commission and provide the better control over sales operation and customer relationships.
Question number 6. The best strategy to be implemented in 2025 in order to boost the company performance and increase its competitiveness in the market. The first strategy is transition to in-house sales staff to reduce the variable cost burden of high commission. 2. Invest in product quality improvement and advertising expansion to double sales and boost brand value. 3. Explore new markets and diversity product offering to reduce dependency on a single product. 4. Implement performance-based incentive for sales staff to drive motivation and result. And the last one is consider moderate price increase only if market ratios support it. For the conclusion, cost volume profit analysis is an effective management tool to evaluate the relationship between cost, volume, and profit. Voltage Sundram Berhad is profitable but still below the 30% of profit target. The company needs to improve contribution margin and manage the cost effectively. With the right strategy, the company can increase profitability and remain competitive in the market.